Welcome back. There's another snapshot of the North American markets. Investors will be watching if economic data in the U.S. prompts the Fed to begin cutting its benchmark interest rate in September, even as the Bank of Canada has now delivered 2 cuts so far this year. For more on sectors that investors should consider in this type of macro environment, now joining us from Green Bay, Wisconsin, is Alex McGrath, Chief Investment Officer at NorthEnd Private Wealth. Alex, thanks a lot for joining us. What's your take, first of all, on the U.S. economy? We hear a lot of different views on whether the economy is headed for the much desired soft landing or if it's going to be a bumpier ride than that.
You know, as much as I'd love, or we'd love to think it's going to be a soft landing, it's probably going to be a little bit bumpy here just because inflation, while the numbers have looked a lot better than they did 18 months ago, even 2 years ago, it's still pretty sticky here in this 3% range, especially, given the GDP data this morning, core PCE was actually showing up a little bit there. And that's where I really get to the stagflation adjacent, opinion that I have, where we're not looking or calling for like a 1970s style stagflation. It's just like the broad definition of it, right? Inflation is sticky or increasing and growth is starting to slow. So that's just kind of the environment we find ourselves in here. And I don't think it's necessarily, the numbers aren't bad. They're not great. We're just kind of in this middling ground, just kind of waiting to see which way the data breaks.
So what kind of door does that open, if at all, for the Fed to begin reducing rates? Sticky inflation is not the type of environment that the Fed would like if it is intent on reducing rates.
Absolutely. And that's why, our opinion has been, we don't need to see those rate cut discussions until you've kind of gotten inflation back pegged to that 2% mark. But the market seems to really, really believe that we're going to get that in September. So if that is the case, that's really kind of what's driving our allocation decisions, right? And so those oft overlooked sectors that are interest rate sensitive, so your utilities, industrials, healthcare, financials, consumer staples, we are going to start to get those rate cuts coming down the pipe. Those are rate sensitive sectors that should do well in that environment, whether that's the right decision to cut rates or not. The other side of that too, should we see that macro data start to deteriorate, those are typically more defensive positions. So it's kind of a double prize for you there.
And we just spoke with a Canadian portfolio manager who likes U.S. small caps. He likes Canadian small caps as well, but he thinks this turn in the market, this rotation that we're seeing reflected in the Russell 2000 index is a trend that is going to endure for some time. Do you agree?
If rates do meaningfully move down, absolutely. Simply because, those small cap companies don't have the same access to the financing to expand operations that your larger caps do. So they've, been meaningfully hurt by rates being as high as they are, where they're out there on lines of credit, 7, 8, 9%. If that starts moving backwards, it just adds cash to their bottom line. So we absolutely agree with that.
Should investors be de-emphasizing those ultra large cap tech stocks?
We don't believe so at this moment. Certainly, days like yesterday certainly make you question that decision. But, we've got earnings coming up for a good slug of those mega caps next week. And, should they continue to meet or exceed expectations, that trade's not going to go anywhere. We might not see the vast upside we've seen in it here recently, but we don't see it as a danger spot.
The U.S. presidential election, in some recent commentary, you characterized the U.S. political situation as an out-of-control tire fire. And I guess we know what you're referring to. One of them is a near tragic event, the attempt on a former president's life. The other, I assume, is the much anticipated and finally realized exit of Joe Biden from the presidential race, and a situation where we believe we know who the Democratic nominee is, but we don't. That's not certainly been finalized. And November is getting closer and closer with every day. What role do politics play here? And is it possible for investors to make some type of call, some type of positioning here, at least partially based on politics?
We would tell our clients certainly not to take that tact with it. Ultimately, there are little differences, I think, especially if you have a divided Congress where you can't just work through big legislation one way or the other. So to us, like, the most important part of that is, like, if Congress remains divided, the person that's ultimately in that chair doesn't have an outsized effect on the equity market. I mean, certainly we would, hope that neither one of the candidates end up running the Federal Reserve, and that doesn't seem to be like that's going to be the case. So, for us, it's really is that if that Congress remains divided, it's not going to have a gigantic outsized effect on the market in general. So no, we don't believe there's a political risk in it at this point.